Greetings, Pro Readiness Trading. Let's get started. Okay, this is an introduction to candlesticks charts, and I wanted to let you know that this is the type of chart that we will be working with. It's this particular market that I'm showing you is the S&P 500. There's lots of various different markets out there, hundreds of them, and when you learn how to trade, you'll be able to use your strategy on each and every one of these markets. Now, I want you to get to know these candlesticks because these are what you're going to be learning on. These are how you're going to keep up and track your market, keep up with the market. There's advantages to using the candlesticks. Now, there could be some potential problems. One in particular that candlesticks, just like any other indicator, is lagging, meaning that the market could have already went in a certain direction way before the pattern itself could have formed. However, with the indicators and with the various different strategy, you should be able to get into the what is called market far in advance, well in advance. I like to say that we want to get in when the banks get in. That's what we call capturing the grid. Again, another strategy that we're going to learn. So we're not going to go too far into, the advanced stage of this. There is various different lines in charting. There's competition. Some people are in the opinion that line charts are better. Line charts, of course, were around um, and actually before the candles in America. But however, candlesticks themselves have existed way before in the 17th and 18th century. But I want to show you what the lines look like. Here's what is called a bar chart. Now the bar chart also has an open, high, low, and close, but however, it's just something about the candlesticks that makes the chart look so inviting, so conveying the message. And you'll learn that once you understand candlesticks. I want to show you what a line chart looks like. That's what a line chart looks like. It's not very much. It's not really being able to tell you where is the open, high, low, and the close for the day. Also, we have some candlesticks that are what is called hollow. Example, I prefer not to use these candlesticks because when we go to having moving averages, which is lines that may land on your support and resistance area, depending on the color, it may interfere with the background. That's why I like to have my candle, the what is called the real body, to be actually a solid color, whether it's red or green. We also have what is called the arch. Well, that's considered a line, but it has a fade in there. There's just so many different types of candles that I could go on. This is one called the Rinko, which is not showing up, but let's see if this one. Okay, here's one called the it's the line break. Again, it's really not showing any information that we could use. And here's one that's going. It's called the Kaji, and then there's another candlestick called the point and figure. Okay, here's one called the range. It looks like a bunch of little Martians or spaceships or drones in the sky. It does show somewhat of a pattern. However, we're going to stay with candlesticks. Okay, now there's candlesticks can give you a great amount of insight. A little bit about candlesticks is that it originally started with this guy right here, Munashi. Munashi Huma is his name, and he dates back to the 17th century. He's also was what is called he started the candlesticks by dealing with rice farms, going out on his daily rice, and he started tracking the market, and he actually, they call him the founder of the candlesticks. I mean, he is the one that, you know, that's they say that he done so many great things. Um, I mean, I can't even begin. I mean, this guy right here, literally started to notice as he would track the investments of his rice fields, he started noticing patterns in the market. And he had a very extreme amount of upper edge in this and being able to track the market at that time in its reversal signals, when the market was going up, when it was going down, when it was time to buy, when it was time to sell. So it gave him what is called a visual representation, you know, and he was more informed about his buy and sell decisions. So around the 1990s, this particular candlestick pattern started to become widely used, and it was way farther used than what is called the line charts, the bar charts, and all those other charts that we see today. It is the most charts that you're going to see. You see them in software, you see them, everywhere, and you can analyze, it's clearly for analyzing reoccurring patterns that prove profitable to many traders. So this is what we're going to use, you know. So there's lots of depth. There's lots of depth, and even though we know that there's different types of candles, you know, the change in the candles, the depth of it, the information of it, it started to change a little bit, and mainly it started to change within the stock market. It started to change within the NASDAQ, New York Stock Exchange. You know, I mean, and what I mean by that is that you can, like, for instance, I live in Missouri, the Midwest, so you can actually, the market actually might close, like, say the market closes from 9:30. Originally, it closed from 9:30 to 3:30. Now it's 8 to 4. However, the market closed actually in Central Time at 3 o'clock. So by 3 o'clock my time, I want to be wrapped up and out of the market because the market can become very, very shaky, and you will attempt to try to make a position in the market, and literally you will not be able to execute that trade, or it may manipulate the patterns that you are looking at because of that. Early in the morning is not a good time to get into your trades. Not a good time to start setting positions. You want to already have your positions. You want to already have the pullbacks. We're going to talk about that a little bit later as you become more and more understanding of indicators. So these this type of candlesticks is going to give you, and I quote a lot, and I say this in my introduction to you guys, a trained eye. You know, you're going to be able to make quick decisions, right? And whatever you do, it's important to know the importance of the close of the market. It's very important to know the close of it because these candlesticks, they offer the open, high, low, and close. So that's why we're going to use them. And so, what makes up a day is dealing with the opening of the market. When the market opens up in the stock exchange, when we have all those traders out there placing a trade. Back then, you had to have a broker. Now we have computers, and we can just simply what is called make a trade, make a position, get out of position. However, would you believe it or not that this is example is that I lost a rule that I violated with a company, a trading company I was working for, is because I was calculating getting out of the market my time, Central Time, And I for sure got out the market within, let's say it was maybe 3:59. However, just the mere milliseconds of that execution in this computer traveling to Chicago to New York to be able to execute that particular trade with the brokers caused me to have a lag to where in fact I was not actually out of that market in time. So just showing you why some people even go and move to New York just to have those extra few little milliseconds. So even your computer can be lagging in time. So it's important to know how to get out of these markets before the time. Before the time and so another good thing about dealing with this market is that it's also 24 hours. What you see right here is the S&P. We know the Nasdaq. We know the Russell. We know various different American markets or have a schedule from 8 to 4 or whatever. But I want to kind of just jump in here and show you something right quick. Let's just take let's just go with the Euro British pound. Okay, so what we see here, these are lots of markets we can get in, lots of markets. So this is the British pound market, and you can get in all these type of markets and literally trade in them. And the beauty about the forex, which is a foreign exchange market, it's just can be according to your schedule. You know, whether you work during the day and you want to trade at night, whether you work at night and you want to trade during the day, you can get into the Nasdaq, you can get into the S&P. Australian, so for instance, the British pound, I believe, opens up in the market at 2 in the morning. I believe the Japanese yen opens up, I believe, around 10. Australian dollar opens up at 2 o'clock. So and then they're always open 24 hours. I like to trade the foreign exchange because I like it. I feel like it doesn't really can get manipulated by by major banks. It's really working well with the strategy, but so is the S&P, so is the other markets, and that's what we're going to learn. So let's get back to candles for a second here, and I want to let's see if I can let's see here. We'll go here. We'll go here. See if I can. Um, yeah, we'll go right here. So let's see. Now there is technical analysis and there's fundamental analysis. You need to know the difference. Technical analysis is analogy of the market, and you're dealing with price action, and you're studying the market by way of chart patterns, which is what we're teaching. Technical analysis. Fundamental analysis is dealing with companies and knowing a little bit about the inside information about that company. You know, whether you're trading Tesla, whether you're hearing some information on the TV, whether you're hearing companies emerging, T-Mobile and um, T-Mobile merging with Sprint, whether or not those are type of information, whether you um, check some what is called some business plans and tax information and all this information. Well, when it comes to chart patterns, you use a little fundamental because news can affect the market, but the market is going to always the technical analysis is going to tell you how to get in this market.